Hello, everyone. Good morning if you're joining us here in Asia, and thank you for coming to this next Sherpa Process Alpha webinar. My name is Stephen Quimby. I'm here with our founder and CEO, Richard Waddington, and today we're going to be talking about practical applications of an objective rebalancing framework. So this is going to be building a little bit on something we talked about last time, which is the Sherpa Rebalancing Framework. We're going to be diving into sort of thinking about variable sensitivity and thinking about how you can use a framework like this to be more informed about changing market conditions and how that should influence what you think about rebalancing frequency so you can make better rebalancing decisions. So again, if you're new to Sherpa's Process Alpha webinar series, we try to be about 30 minutes. Sometimes that works, sometimes it doesn't, but we're shooting for around 30 minutes. Usually we take Q&A at the end, though if you have any questions midstream, feel free to put them in the webinar chat on the side. And if it's urgent or if it's particularly apropos to what we're talking about, we'll try to get to it as we go. Otherwise, questions at the end. And for those of you who come in late, or for those of you who have to jump out midway through, we will have the session replay online on our Process Alpha YouTube page probably later today. And if you'd like to reach out, we're happy to share the slides with you as well. So with that said, today what we're going to do, we're going to walk through sort of reintroducing or revisiting the framework, the Sherpa Rebalancing Framework that we introduced last time, and what the critical drivers are of thinking about the ideal or optimal rebalancing frequency. Then we're going to look at the sensitivity of a few of the drivers that we didn't talk about last time. And these are the drivers that are a little bit more market driven rather than sort of firm or PM driven. And so that's going to be volatility and the estimate of your expected alpha. Then we're going to look at how all of this fits together. When we take all these drivers and put them together, what does it actually mean as you think practically about how you would apply this framework to make better rebalancing decisions? And again, as I said, we'll do Q&A at the end. So the reason we're talking about this today is this is an area where, in our experience, as we talked about prior, most PMs are fairly fuzzy about how often they should rebalance the book, when they should be thinking about individual sort of trades and sizing of that versus when they should be looking at rebalancing as a whole. And they're also quite fuzzy about thinking for a given strategy. I mean, your average long short PM thinks they should rebalance much more frequently than they probably should. And your average long only PM never rebalances, and they just sort of shift along, adjusting around the margins. So we've introduced an objective framework, what we call the Sherpa Rebalancing Framework, as a tool to help PMs think through rebalancing frequency and ultimately make better decisions. And by looking at some of the sensitivity of what we say are the four key drivers of rebalancing frequency, you can better understand how in different market conditions, or how based on your unique process, you might think about rebalancing. And so these four drivers, again, the first one is how frequently your views change. So this isn't a dollar turnover metric, but this is thinking about in terms of the stocks you want to have in your portfolio, or in terms of your convictions, high conviction versus low conviction. How often do the views you're expressing in the portfolio change? Second, how much alpha do you expect to have? Obviously, if you expect more alpha, then you have sort of more return to work with, and also a greater expectation of return that pays for your rebalancing. Next, we look at how volatile the assets are. And finally, we look at how much transaction cost are you incurring by trading. And so each one of these is going to be unique per PM, unique per firm. It can change through time. And so this framework allows a PM to measure these particular inputs and to come up with an optimal or ideal rebalancing framework from them. So what we're going to think about in the context of this framework is we're going to look at how changing these drivers changes the outcome for different rebalancing periods on return space, on volatility, on drawdown, on Sharp. I mean, you can dive into this in great detail, and this is something we do with clients. But in this case, we're going to focus mostly on sort of returns and risk-adjusted returns on Sharp. But we're going to use this framework to take those drivers, vary them, and see what the implication would be for a given portfolio strategy. So the first two drivers that we've talked about last time, and we're not going to dwell on as much today, so if you missed the last session, by all means, go check out the webinar on our YouTube page. The first two drivers are things that these are relatively stable, and as a PM or as a firm, you have some control over them. And the first one is frequency of change. And the second one we talked about last time is transaction costs. And so frequency of change, a PM could ramp this up, could ramp it down, but generally speaking, this is a function of the opportunity set and a function of your process, your unique MO as a PM. And so while there might be some variation, this is something that generally speaking as a PM, once you get a good feel for it, this isn't going to change very dramatically. And if it does, it's in your control. Transaction costs, this is something where, again, as your fund grows, your transaction costs might change somewhat. If you were to change the types of assets you invest in, if you were to have a change in your mandate that allows you to go, say, further into smaller cap or to go to a different geography, maybe it changes. But again, by and large, transaction cost is going to be fairly static because it's a function of the relationships you have as a firm, the efficiency of your trading desk, what you trade. So these are things that we say are fairly stable and you have some control over. Now, the other two are things that vary in time and that most PMs have much less real control over. And they might think they have more control over one of these, but in practice, it's something that's driven mostly by the market. And the first is the volatility of the underlying assets. And the second is the reasonable expectation of the PM's alpha. And so as any investor knows, there are periods in the market where volatility is very high, and there are periods in the market where volatility is relatively low. And so if you just simply take a given vol reading, a 30-day vol, a 60-day vol, a 90-day vol, average vol over the last 5 years, you're going to end up with very different readings at different periods of time and for different times you measure it. And so vol is something that happens to you as a PM in the context of this rebalancing framework. You don't have control over whether or not the market's in a period of heightened or lower volatility. Similarly, with expectation of alpha, you might have a long track record that gives you an idea that you trade at a particular sharp or that you have a particular hit rate. But there are periods in time where your style works better and periods of time where your style works worse. And that's something that, again, as a PM is more subject to the macro regime. It's subject to the market environment rather than necessarily changes you make as a PM. So both of these drivers are less stable and they're less under the PM's control, which is a critical differentiator because as a PM, you need to be prepared for uncertainty, which means you need to be prepared for how these drivers can change through time and what the implication is from that on your optimal or ideal rebalancing frequency. So if we can understand how all these drivers play together, and if you as a PM can get a good estimation and understanding of what these metrics are for your portfolio, this gives you a very objective framework for looking at different frequencies of rebalancing, different ways you would rebalance the portfolio in different conditions. So then you're prepared. You know if there's a volatility spike, you should be rebalancing more or less frequently based on the other inputs you have. You know that if there's a period where your style kind of is running out of favor, again, maybe there's a benefit to rebalancing less frequency or maybe more frequently. But again, these are decisions that don't tend to be as clear-cut and intuitive as you might first think. But having this framework gives you an objective way to navigate the thought process. And so what we're going to do today, we're going to dive into showing how this works. And so we introduced last time at Sherpa, we try to make sure that everything is sort of statistical rather than looking at a particular point in time, a particular sequence, a particular implemented portfolio. And so the way we're going to look at the outcome of varying these variables is by running as many different simulated paths for each different rebalancing frequency. And so this means that rather than looking at sort of one particular sequence of asset selections, we can look at a number of different asset selections based on their characteristics and then see how varying rebalancing frequency impacts the results of those particular asset selections. And so we're going to summarize this large block of data usually what we do for clients is we look at the 25th average and 75th percentile results to give you an idea on average, how does this set of drivers impact a given set of outcomes, but also to think around the margins, what's the spread? What would we expect how bad could it be? How good could it be? Sometimes we extend this, go to the 10th, 90th percentile. Today, to keep it simple, we're going to focus on the averages. And so we're going to look at the same data set we looked at last time. So within this same data set, it's a benchmarked long-only EM portfolio. On average, the book's holding around about 40 stocks. Asset views are simply 1 or 0. They're included. Research wants them in the portfolio, or research doesn't. To keep it, again, simple, we're going to market cap weight the portfolio. It's going to be a benchmark relative to the index. Average active shares, call it 55, 50, 60%. So we're going to look at the same portfolio we looked at last time. We're going to vary some of our initial starting conditions, and then let's dive into the data. So Richard, what are we looking at?
Yeah, thanks, Stephen. Last time we talked much more about the first two drivers, as Stephen said, about the frequency of change and transaction costs. And today we want to look at how does your hit rate, whether you call it quantity of alpha or hit rate or how good you are, how does that impact where you should rebalance the frequency? And volatility regime, when volatility changes, how does that impact your frequency of rebalancing? And this is kind of important. We'll come back to this again a little bit later, but many PMs we find are sort of ex ante constrained to a certain amount of turnover. And the point being that as volatility rises, you should probably go to revisit that number. And we'll explain how that is later. So let's look at what happens as you increase or decrease volatility. This is the blue bars are the Sharpe of your portfolio. And remember, it's that portfolio of 40 EM stocks, benchmark relative. So the Sharpe of the benchmark relative returns for different rebalancing frequencies at the volatility that the market typically had, which where the index was about 25 vol. Now, transaction costs are set here, I think, at 25 basis points for every trade. This is an EM portfolio, so that's sort of reasonable. And it's clear that given the amount of alpha you have, the hit rate, we said like 53% hit rate, and the quantum of view change you have, the amount of times per week, views per week that change, rebalancing every 2 weeks gives you a better result. Of course, I write here caveat TC, caveat transaction costs. That's with transaction costs of 25 basis points. It's intuitively obvious that if your transaction costs go up, your optimal rebalancing frequency will shift a little bit to the longer. What's kind of interesting is, though, is as volatility changes, the rebalancing impact gets smaller. Now, you can again understand that by thinking that a lower overall volatility means for a given hit rate, your total returns are going to be less. And the spread between the different rebalancing regimes will also get much less. And also bear in mind that transaction costs will be a higher proportion of the total amount of return. So there's already some sort of interaction here that goes a little bit beyond what's on this these four blue bars. So you can see this, and it kind of makes sense, but in the back of your head, keep in mind there's other stuff that can also impact the outcome that you're going to experience. If you have a higher vol regime, first of all, of course, you're going to get overall higher returns because you're with the same hit rate, a higher vol. When you're right, it's a higher vol, things are moving more, you're going to make more money. Transaction costs will be less important, but you can see that the 4-week rebalance starts becoming clearly better than the 2 or the 8-week. And that is a function of the frequency of your view changing and the quantum of your alpha. And we'll see how that all interacts later on. So it's not, the intuitive thing might be, oh, we've got higher vol, we should rebalance much more often. Actually, it interacts in a little bit more subtle manner with the other drivers of your portfolio, how much alpha you've got and how often your view changes. You can see this in the graph. This is graphing the same data over volatility. So volatility is the x-axis. the average, the vol of the index at 15, 25, or 60, you can see how the 4-week rebalance becomes the best option as the volatility gets very high. But it still kind of relatively makes sense. But the fact that that crosses over the 2-week one is perhaps a little bit counterintuitive. And you really need to run all the sensitivities to see how that works. So keeping, it's sort of physicist speak, right? Provided no external forces act, right? Keeping everything else simple, constant, the reaction function to volatility is kind of intuitive, although that flip into the 4-week rather than the 2-week is perhaps a bit surprising. So that means rather than just saying, oh, volatility is going higher, we must rebalance more often, we have to take into account the specifics of our portfolio, our alpha generation process, our hit rate to get to the right number. Now, if we, again, let's hold everything else constant and look at what happens as we change our alpha, our hit rate, effectively. So we can say, well, for this set of decisions, let's go from 52% to around about 56% hit rate across different, we call it skill levels or quantums of alpha, whatever you like to call it. So in the kind of middle amount, which was the original portfolio, I remember 54% hit rate over the full set of decisions that and this data is run over several hundred simulations across a year's worth of deciding. So there's a lot of underlying data here. It's a stable result set. With the transaction cost set at 25 basis points and the 54% hit rate, remember that we were saying our optimal rebalance is 2 weeks. If our hit rate drops to 52%, well, the first thing to notice is, of course, because we have a transaction cost at 52%, there are some times when, first off, you have a much more randomness in outcome, right? Because you haven't got as many things that pay you off. And sometimes you can have ones that just lose money, and the 52% isn't enough to make money, certainly not when you're paying transaction costs. So you have more randomness in your overall outcome, and the transaction cost really kicks in 2-week relative to 4-week. So there's like, oh, as we go into a market environment in which we are less sure of our ability to generate alpha, there's a playoff here between how much we should rebalance and how good we are feeling about ourselves. If we're feeling really good about our ability to generate alpha, so our hit rate goes up to 56%, which is pretty high in the kind of context of this sort of trading, then the 2-weekly rebalance, even though there's transaction costs in it, starts outperforming the 4-weekly rebalance. So there's these crossover points, and then they're not intuitive. You never really know, or you can't really work out where these points cross over without doing the analysis. But there are these crossover points in which quite significant changes in the way you run your book, right? Rebalancing every 2 weeks or rebalancing every 4 weeks is quite a big change in the way you run your book. Rebalancing every 4 weeks or every 8 weeks has quite a big impact. If you look at your Sharp dropping from 2 to 1.5, right? A 2 Sharp is something that you can really shout about. A 1.5 Sharp kind of puts you back in the sort of the middle ranking of everybody else. So the impact can't be, you can't ignore the impact of these things. It's quite important. And you can't really know without the analysis where the thing is going to impact you. If you plot the same thing, doing the same style of graph, where we, on the x-axis, look at how much alpha you've got, and we look at how the various rebalancing frequency returns vary. Again, we see when you have low skill level, when your hit rate is low, it doesn't make so much difference how often you rebalance. But when your hit rate gets higher, it starts making a very big difference. And again, exactly where this starts becoming, where that thing widens out, it does vary depending on how frequently you change your views, and as we discussed previously, how volatile they are. So behind these pictures, which are pictures of two things moving, there are two other things that can move. So again, the picture is useful, but it's really useful to remind you, actually, it's harder to work out than you think it is. So in kind of, I mean, I don't know, it's not really a summary, but you will have an intuition of how these things vary, but it's very, very hard to understand, to grasp where the right thing is, right? It's not always rebalance more frequently. It's not always, oh, transaction costs are rising, rebalance less frequency. The things interplay in a way that is not absolutely clear. So if we do a next look at it, and we move both volatility and how much alpha, right? Remember, these are the two things which kind of happen to you rather than you control. Again, low volatility, the primary thing to understand about low volatility is it doesn't really matter so much what your rebalancing frequency is if the volatility is much lower, although as your hit rate increases, that spread does widen out. In the high vol, and now you're beginning to get a feeling for it, in your high vol, the first thing that is clear is that the spread widens much faster as high vol, as volatility rises. And in a high vol environment, even with transaction costs, it turns out that rebalancing more frequently becomes more important. So this is, again, what I said earlier on. If you are a manager who says my turnover is something that I constrain ex ante, irrespective of volatility regime that I'm trading in, then you are likely to be missing something as volatility regimes change.
And I think there's another interesting point on this particular one, is that if you have less confidence in your skill, in your alpha, as volatility spikes, as there's greater uncertainty, as the market's all over the place, you need to be really honest with yourself where you are on this axis. Because if volatility increases and you say, okay, well, this is great, opportunities are rich, they're everywhere, then you're in that good, high, best bucket where you want to rebalance much more frequently. If you're saying, oh my God, the market's going crazy and I feel very uncertain about things, that's a really big difference between those two.
But I think that the message you just said there in the middle, Stephen, like, be honest with yourself. The act of decision making to choose various assets is a part of your process as a manager. But the act of converting that into portfolios, managing the money, rebalancing, is something where you really do have to be honest with yourself and understand, how do you trade? What are your drivers? Because making false assumptions, which then lead to different portfolio construction or rebalancing decisions, has big impact on your end result, irrespective of how good or bad your asset selection decisions are. I'm on the wrong screen here. There we are. So volatility, alpha have an interaction. Transaction cost, the way the market moves, all these things are changing how your end results are for the same set of asset selection decisions, right? This is kind of important. We're not in anything that Sherpa does, we're not talking about improving your ability to select assets. We're talking about improving your ability to express your asset selection in the risk-taking portfolio. And we've come up with our 4 drivers. It's very hard, of course, in 2-dimensional pictures to show how everything interacts. But if we take a couple more examples where we let a few more things interact. Okay, here, what have we done? We've increased transaction costs. and we've increased the quantum of the number of asset selections you make every whatever the period is, weekly or sort of here, right? Of course, as you increase transaction costs, that's going to drive the higher rebalancing frequency. So the blue line is going to get driven lower, and it's driven lower to the extent where no matter how good you are or how good your hit rate is, in the high transaction cost, high view turnover regime, the blue line, the 2 weekly one, is always the worst thing. But what is interesting is that the 4 weekly one really stands out as being the best thing as long as your hit rate is reasonable. And that's kind of counterintuitive, right? It doesn't go, you can see it at low skill level, at low hit rate. It's sort of intuitive. The 2 week, 4 week, 8 week, 12 week go in order. But as your skill rate increases, it no longer goes in order. And because of the interaction of these things, the 4 week suddenly becomes the best thing to do as your skill rate goes up. And this is part of the sort of counterintuitive nature of it. You shouldn't really be, or you shouldn't think, oh, God, transaction costs are increasing, therefore we must definitely go to the lowest possible turnover or lowest possible trading frequency. We must think transaction costs are increasing, but given everything else we should be doing, let's do a new analysis and say, oh, actually, it turns out that 4 weeks is better. If volatility goes much higher, well, again, we see that the 4 week still remains the best option, but as volatility increases, the alpha you can catch by trading more starts overriding that higher transaction costs, and the 2 week line starts rising. And you can see here in the high vol regime, as long as you've got mid to good alpha generation, your hit rate is 53 to 55+%, then the 2 or 4 week are better than the 8 or 12 week rebalances. So again, you kind of, that sort of makes sense to you intuitively, but there's no way your intuition will let you know where that switchover happens, and for any given regime you're in, what is the absolute right thing to do. So we're kind of constantly repeating this mantra. Your intuition gives you an idea of direction, sensitivity, maybe your first derivative of everything, but the point at which things fall over is outside your intuition in most cases. So the kind of takeaway from all this is that the way to come up with the best rebalancing frequency, I mean, that's the output of this, is to have some sort of objective framework in which you key in the characteristics of your portfolio and you run the analysis in an objective manner. It has to match your intuition in certain first order effects, but it's going to give you much better ideas of where things cross over and what the right answers are. Remember, we need our 4 drivers, the 4 drivers of what is the right answer, the 4 drivers. How do the assets move? How often do you change your view on any assets? How good are you? What's your hit rate in rest thing? And how much does it cost you to trade? Right? Once you know these drivers, and even if you don't know them factually, you're going to know things like transaction costs factually. You don't know your ex-ante alpha perfectly, but you have to have some sort of idea of them. Once you have this knowledge, you can use a framework to make decisions. And if you use a framework to make decisions, the Sherpa framework, for instance, will provide information like this to you. It'll say, for a given portfolio, for a given way of running money, which is the top left sort of yellow box, what is the optimal rebalancing frequency, and what is the impact of doubling that frequency or halving that frequency? That's the boxes on the right-hand side at the top. Then underneath, Well, if your portfolio changes, or your number of view changes from between 5 to 8 to 10 to 15, then your rebalance frequency optima should be 2. If your transaction cost goes from 10 to 25 basis points, it should go from 4 to 6. You need to know not only where are you right now, but how sensitive are you to these things, so that you can plan your way of running your money in the face of things changing. If volatility increases, how does that change? And of course, this particular report is showing you for these changes independently of each other. You may want to see the changes all together and see another set of results. So the point of the framework is, once you know your inputs, once you know your style, your portfolio, your asset set, you can understand when you should rebalance and how things impact both the return stream and the optimal rebalancing. Now, interestingly, about those things you need to know, the frequency of your view change, the alpha, the way your assets move, the volatility and covariance, and transaction costs. These are the same things you need to know if you're going to try and systematically build your portfolio. And if you've watched, as I'm sure you all have, if you've watched our other Sherpa Process Alpha webinars, they are all about using process to build your portfolios better, to construct portfolios that express your views in the best way possible. And in all of them, we hammer the same points again and again. You must know stuff about yourself in order to construct a portfolio, to take risk in the best possible way. And so the process which we go through, Sherpa, we go through with our clients about understanding how they generate alpha. We don't tell them to generate alpha differently. We need to understand how they generate alpha, how frequently their views change, what the assets are. These same discussions, these same understandings not only drive the best way of building a portfolio, they also drive the best way of rebalancing and trading a portfolio. And the whole thing is a holistic view of converting the skills you have as asset selectors into the portfolio which best represents those skills, best delivers the outcomes that those skills generate to your investors.
Yeah, I think that's very well said. And so really getting those inputs right is an ongoing process for most PMs. It's something, if you ask most PMs to write these down, again, we always ask whether it's constraints, whether it's estimation of alpha, frequency of view change. If you ask most PMs to write these things down on a white sheet of paper, it's tough. And so we can help with both getting the inputs right and then with bringing the framework to bear to help you better understand how to rebalance your portfolio. So if you want to learn more about this topic, again, if you joined us late, feel free, reach out via email. We're happy to send you the slides. You can check out this video and our prior video talking about the same topic on the Sherpa YouTube page. If you have any questions or want to look at actually how often should you rebalance your portfolio, reach out to the team and we'd be happy to walk you through the process and show you how you can put this analysis into practice running your own book. So with that in mind, we're running a little bit over time. So I don't see any questions in the chat. So please, if you do have any questions, reach out. We're happy to talk. We think about this stuff all day and love to go through it with you. So Richard, thanks so much for taking the time to present with everyone today. Everyone out there, thank you so much for taking the time to join us, and we'll see everyone again next time.
Thanks very much, Stephen. Thanks, guys.